Looking at my portfolio, there are many companies that I've seen over the last year go down significantly in price, and some have performed much better than others, but one company that I feel like is often overlooked, and the one that we're talking about in today's video, is Dropbox. This is not a company I currently own. Ticker symbol DBX is one that typically people overlook because it's generally a boring company. People don't think of this as a high-flying tech company. And this company has been at the same price basically since its IPO. It's actually lower. It initially IPO'd around $30 a share. Today, you can buy it at $23. Now keep in mind, this company did not go IPO last week, last month, a year ago. It went IPO almost 5 years ago, around March of 2018, so we're about to hit the 5-year anniversary, and this company has not went up in price at all, despite it having incredible revenue growth and profitability growth, and overall this is the company that I'm interested in. Right now in my portfolio, I'm pretty much maxed out in terms of companies that I can buy. I am pretty much out of money, and so far in January, this is our performance. We're doing pretty dang good so far, and my company portfolio allocation is broke down as such. As you can see from this holdings chart right here, we'll be updating this month over month in the very next video. But so far we've done pretty good, and we bought a lot of good companies, and we're going to talk in this video everything Dropbox. A quick overview looking at their most recent investor presentation, and talk about all the major bullet points that I think are important, and give you a good financial perspective as to whether or not Dropbox is a company you want to buy. Let's go ahead and get started by looking at this company's quarterly revenue growth. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up below using my special referral link, you can get anywhere from 1, 10, or even as high as 20 stocks for signing up when you use my special referral link down below in the description or in the pinned comment down below. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Okay, we're back, and like I said, since 2017, this company has been growing its revenue quarter after quarter after quarter after quarter, every single quarter since it initially started disclosing it when it went IPO about 5 years ago. Now, initially, this company was doing $247 million in revenue, and now in the most recent quarter, it's doing $591, which is well over a double up, and the company's profitability has been trending in the right direction as well. Initially producing about $50 million in free cash flow a quarter, now we're producing around $250 million, about a 5x in free cash flow, which is essentially the profitability, and it's getting better and better. And if you look at their actual free cash flow per share, that's when things really get good. Over the last 2 years, compounding at 24% compounded rate year over year, and it is now doing around 68 cents a quarter in free cash flow per share. Now, this company has raised that free cash flow per share mostly by buying back significant amounts of stock. Now, this company's been buying back a lot of stock, and this has been benefiting shareholders by owning more and more of the company, but the share price has not gone up. And this leads us to the question, why has the share price not gone up? I have a couple of reasons to believe why, but we're going to talk about the pros and the cons of owning a business like Dropbox. Notice some of the platforms that it integrates with. Google, Microsoft, Slack, Atlassian, Salesforce, Adobe. Two of those names on that list, out of those 8, I actually own. I own Salesforce and Google. So this integrates straight with 2 companies that I already invest in, as you can see from this portfolio allocation right here. Now, this company offers a subscription service to storing data and storing photos and videos, and they also have business offerings. And we're going to talk about the plans that they have in just a second, but these plans have been growing so far in terms of number of users, but also ARPU. ARPU, which is average revenue per user, has grown significantly each and every year from 123 to 128 to now 133, and it's getting higher in 2022. Now, this company has a barrage of different plans on both the personal and the business side. Now, I'm going to go ahead and stop here just so you guys can look. They have a bunch of different plans at a bunch of different price points and a lot of different offerings that they can offer their consumers. Now, if you want to pause this and you want to look over these pricings and what it offers, I would recommend doing so. But basically, this is the vast array of different product offerings that they have. Now, overall, the whole company as a whole, not just the users, not just the revenue, has been going up. But as we mentioned, the free cash flow, the margins, all that good stuff has been growing, and they're still projecting that this will go higher in the future, which is what's really interesting. They're projecting $1 billion in free cash flow by 2024, which is a pretty significant ramp up when you factor in that last year in 2021 they did 700 million. They're projecting by 2024 that that goes up to $1 billion, which is about a 35% or so increase, which is pretty awesome there. Now, this company is getting out of its old school backup and sync model and getting into new platforms, new categories. And this is what's interesting. I have 3 examples here, which is Dropbox Sign, Dropbox DocSend, and Dropbox Capture. Now, we can talk about this, but basically the first one, Dropbox Sign, it's a lot like DocuSign. You need a document, especially if it's a legal one that needs to be drafted and signed and disclosed properly among all parties that are involved with the document. Dropbox can help with that. If you need Dropbox DocSend, if you need to share documents, whatever it is, which of course obviously integrates straight with Dropbox Sign, you can share these documents and you can use them for other options as well. It doesn't have to just be Dropbox Sign documents, but it's just another option to share different types of products, different types of platforms and documents throughout the service. And then last we have Dropbox Capture. Similar to what I'm using right now with Microsoft, I can screen record my screen, I can take videos, I can take pictures, and I can use this platform to record what I'm doing inside of my computer, and then I can share it, integrate it, edit it, and do whatever I need to do and capture it 1080p at very, very good high quality video capture, and that is all included in through this subscription plan. Now, all 3 of these are not revolutionary. This is not some type of product that no other big tech company has, and this is what I want to mention, is that this company, respectfully so, trades at a lower valuation. The forward PE on this company is less than a 13. Now, if you compare this to another company, a big tech company like a Microsoft, keep in mind that this company is not a Microsoft. There's a reason why Microsoft trades at 2x the forward PE at a 27, because Microsoft has a much more dominant market position. They're significantly higher, doing almost $200 billion in revenue every single year and tens of billions of profit. Microsoft is in a category of its own, and it deserves to trade at a higher valuation. However, this is something interesting here with Dropbox. As the company continually grows, we showed here that they're growing average revenue per user, they're growing the amount of users, their plans are expanding with different products like Sign, DocSend, and Capture, and overall this company is projecting future higher cash flows and revenue moving into the future. But what is the key part about this investment that makes it so interesting? That low valuation. As the revenue, as the profitability has grown higher and higher and higher every single year, what has the share price done? It's done nothing. It's stayed flat or even downtrended for 5 years straight. And as those shares get lower and lower each and every quarter, this makes this valuation more and more and more compelling. Now, I'm not saying this company deserves to be trading at a 30 or a 40 PE. Heck, I don't even think it deserves to be trading at a 25 PE. But honestly, at a 13, that's pretty darn cheap, and that's significantly less than the average in the market, which is pretty shocking considering that this is overall a company that has return on capital employed well around 6% per quarter. If we look at this on an annual basis, it becomes much more apparent. Last year was 14%. If you look at their gross margins over time, you can see the direction they're going. They're getting more and more profitable. Same thing can be said for their operating margins. They initially were negative, now they're turning into the positive 13% range, and then profit margin, similar story, around 16%. You can see that overall this company is heading in the right direction. They can put in capital when they need to, and they can get a decent return on it, well into the double digits. It's a company that's growing. It's a company that has a lot of cash on hand. They have significantly more cash than debt, around 0.25 billion worth, and this is not an indebted or leveraged company, and it's one that in my opinion doesn't have a significant amount of risk because they keep growing their users and growing their revenue. So overall, as this company continually grows its profitability, they can buy back shares with more and more profits and at a faster and faster pace. Now notice when a company buys back its shares, it's similar to a dividend. And when this company buys back shares, they do it pretty heavily because in the last year they bought back 7% of the company. I'm going to repeat it again, just how crazy it is. They bought back 7% of the business just while just having their ownership increase for more and more shareholders. They've increased year over year. The shares outstanding from 385 million down to 358, which is about a 7% downturn, and that's pretty substantial, almost like receiving a 7% dividend, which you just do not see out there very often. So Dropbox, is it the best business in the world? No. Are there better opportunities out there? Maybe. But when I look at this, when I see that it's a business that's growing, it's one that I think is still trying to innovate, expand its product offering, and overall become more and more financially diligent, I think it's one that I want to potentially be investing in. So around the $20-ish a share range, 20 to 25 is really where I get interested in this company. And when I intentionally sell out of Crocs, which I have that contract expiring in March 17th of this year, which is about a month and a half from now, I could very well be selling out of Crocs and moving it into a company like Dropbox. Thank you guys so much for watching. Check out MooMoo down below if you haven't already. Thank you for watching all the way to the end, and I'll catch you guys next time.